Hey guys, welcome back. I'm your host, Ideal.
And I'm Carlos.
And we're back with the fabulous Olga with American Financial and Tax Services. By the way, you forgot to mention that we've upgraded.
I was just thinking that, and I was like, oh my God, look, we have our own
We've
shirts.
upgraded, guys. This feels
We have our
so
own
much.
merch.
Yes, our own merch. I was like, he didn't mention our shirts.
No, I know. I thought about it. Sorry.
Okay. Well, credit. We know. I feel like we've upgraded for sure. This looks cute.
Moving up in the world.
Yes. Okay, so today we want to talk about tax breaks for renters, if any, and Olga is going to help us. Even though we dove into it a little bit in the last episode, we really want to hone in and help our renter viewers, see what their options are as far as renting and tax breaks. So with that being said, most people think that renters don't get any tax perks, right? Is that totally true, or is there some leeway, some help for them?
So renters usually assume that they're left out of the tax break party, but it's not entirely true. There are some things that renters can take advantage of, which are tucked into the tax code, especially at the state level. Okay, remember, renters are not going to receive any benefits from the IRS, or few benefits from the IRS itself. But at state levels, depending on where you live, there are some perks you can go into. Some of them include the renter's credit. Like, for example, in California, it's up to $120 if you're joint filers, and that's a month. Minnesota, refundable credits up to $2,640, which you get, it's a credit. It actually reduces your debt. It's not a tax deduction. Okay, it's a credit. Okay. New Jersey allows about 18% of the rent that you pay in a year to be deducted from your income. Okay, so again, there are some. The home office deduction, which we talked about in the last episode, it also benefits, again, if you meet all the criteria for home office. Okay. There's some states that have what's called a property tax pass-through. So if you pay property taxes included in your rent, you get to take that deduction. Okay, but again, these are mostly at the state level, not at the IRS's level.
So, I don't know if you know. I don't know if this is really a CPA question, or maybe it's an attorney question or not. But why do you think homeowners get more breaks than renters do?
Because the U.S. tax system is designed to encourage homeownership. Okay, it has all of that's part of the American dream. Okay, and the tax system the tax code was written to benefit homeownership.
The tax code changes every year, right?
Yep, it has more words than the Bible. Yeah, when you think you know all the answers, they change the questions. Yes. So absolutely changes every year, especially in election years.
Yes.
So just to touch up on this really quick, are there any tax deductions renters can claim related to where they live?
Sure. The home office deduction and the property tax pass-through are the two major ones, and then the state renter's tax credit.
With the
renter's
cap
credit.
that you had said.
Correct.
The $1,500?
$1,500 is for the home office, yeah.
Okay.
The home office.
Okay, perfect.
So, and again, I think we covered this in the last episode, but again, so the home office, if they have one, can they have it as a deduction?
Yes, they can have a deduction for home office. It has to be a designated space just for the use of the business. Okay, whatever business it is. You could be a realtor and just be using a computer in an office space, and all you have in there is your leads and all of the things for every renter. The email that's on there is only your business. If your personal email is on the computer that is in that office, it's no longer only for the use of the business.
Oh, wow.
Therefore, it's not deductible. Okay? I'm not going to tell you you're not going to find a tax preparer that's going to deduct it for you. You will. It's not right.
Okay. Yeah.
So how would you separate? I mean, because emails now are online.
You have a computer that only accesses the business email.
So the account specifically for you don't open up another.
You don't open up anything else. It's not on that computer. On that computer, you can have, for example, in your case, you're a realtor. You have your MLS listings. You have your customer files. You have all the houses that you've shown them. You have your Mile IQ, for example. You have all that stuff on there that's only related to contracts and to the work that you do for real estate. The only email that's on there, whether it's on Gmail or whatever, is the Gmail for the business. for, whatever email you use, only for the realty. The files that are in the desk, to that extreme, cannot be your personal electric bill.
Oh boy.
Okay?
Yeah, I don't-
So you have to have stuff separated, completely segregated.
So I have to remove all of your personal stuff.
Wow.
I was
Okay.
talking to my daughter behind the screen, but
That's
Yeah.
very delicate.
There's a lot of criteria that has to be met, and then it's limited to $1,500. Is it worth having 2 desks and
Yeah,
2 sets
no,
of files and
no.
2 computers and to get
Although some
$1,500?
people will go the extra mile
Oh,
for
yeah,
it.
they will.
no, I'm
Trust
sure they will, but
They
no, not for me.
Not worth it for me.
It's not worth the headache.
I know.
I like to sleep at night.
Yeah.
It's like,
Yeah.
For sure.
Do something else to get the $1,500 deduction.
and again, it reduces your taxable income. It's not like you have.
Yeah,
It's not like you have
it's
a
not
credit, right?
Yeah. No. What about people who run a business from their apartment?
Mm-hmm.
How does that work for tax purposes? Like,
Okay, so again, if you work from home, okay, and you use part of your rental exclusively for business, that exclusivity is extremely important. Under the simplified method, there's 2 methods to deduct the home office. Simplified method gives you $5 a square foot. You don't have to keep any receipts. So if it's 100 square feet, you got $50. Yay. Or $500 rather. So it's nothing. Seriously,
it's not.
it's okay. The regular method is where you get to deduct a percentage, and that's based on the square footage. So if it's a 10 by 10 room, you have 1,000 square foot apartment, it's 1/10 of whatever your expenses are. That includes everything, so your alarm, your utilities, water, electricity, garbage, everything. Your homeowners association, if you pay it, all of that, all of the expenses from you renting would be deducted at 1/10, up to $1,500.
Is there a difference between office space and business space?
No, you can have a home office. You can also have in your garage. Let's say you're selling widgets, and you have all your inventory on pallets in your garage. The space in your garage can also be used as a home office deduction.
So it falls under the umbrella of
Under the
home
home-
office?
yes.
Okay.
So if it's used exclusively for business,
Right.
you
Okay.
can.
Okay.
okay.
All right. So local and state taxes, benefits that they should know about.
So again, there are some state taxes that are available. The renter's credit is the biggest one. They offer, it's basically a rebate or a credit against any rents that you paid. The states that offer it are very few and far between. There's only 5 out of the 50 that offer the credit, only because their rents are so high. Okay, so it's right now it's California, Minnesota, Arizona, Colorado, and Connecticut.
Really?
Okay, notice New York isn't in there.
That's why I was like, wait, what?
I
Really?
know Connecticut's expensive.
Well, New York has a
California,
lot of benefits for. They have the
Rent
low
control.
rental and the rent controls, so they don't give you the benefit twice.
Oh.
I know Connecticut
Shocking.
for one is like really expensive to live
Yeah.
in. Yeah. Actually, one of our shows, and I think the property tax, there was a comment from someone in Connecticut, and they were like, "Oh, imagine you living here."
Yes.
Yes.
I remember.
Yes.
Now that you mentioned it, yes.
So compared to ours, they're a lot more.
I mean, I really thought New York would be up there with California.
Yeah.
But
But
okay, cool.
don't live in California.
No. Not my, no. Let's not get into that. This is not. So now that we're on renter's credit, right? Can you explain what that is and how someone can qualify for that? Like, what is it?
So the first thing is your address has to be in one of the states that offers the credit.
Okay.
Okay, so the address where you're renting, the address where you're filing your return has to be in that state. Number 2, you have to be required to file a return in that state. And the reason I say required to file a return, remember, if your income is below a certain level, you may not have to file because your deductions are greater than your standard deduction is greater than the income you made. You don't file a return. Even to get the credit, you can't get a refund for these credits.
Makes
You're
sense.
just going to reduce your tax. So if you don't owe any tax, you don't file a return. Okay.
Okay.
The third thing is that it's limited to the states, and Florida, because we do not have a state income tax at a individual level, okay, does not offer the renter's credit.
Okay.
So
Good to know.
can renters, let's get creative for them. Is there any way that they can, like, get their expenses together so that they don't miss any possible deductions?
Sure. Basically, most of the expenses that renters can take are related to the business use of the home. The first thing I would do is keep your expenses in good orderly fashion. Keep a spreadsheet, keep a QuickBooks, however you want to keep them, it's fine. Okay, I usually tell my clients to do two things. Number one, keep all of your expenses in one bank account, one credit card, or two credit cards. Even if you don't have a business established, okay, keep the expenses in one place. It's a lot easier to go through one credit card a year at the end of the year, because people do not do this till the day before they have to do their taxes. Okay, if you have April 15th taxes due,
Guilty.
April 13th, I'm
Very
getting
guilty.
files from clients. Okay,
Yes.
I end up filing extensions on April 13th, 14th, and 15th. I file more extensions as the rest of the year.
Come April 1st is when I'm setting the appointment.
Okay,
with her.
yeah, but again,
Oh,
people just push it away and push it away and push it away, and it's understandable. It's not a good thing to do, but being prepared, and you can just be prepared during the year. So every time you get your bank statement, every time you get your credit card, highlight it, whatever has to do with business, and have it in a place. I tell clients that are truck drivers, for example, I tell them, keep an envelope inside your car that has the month on the outside. Every receipt, just drop it in that envelope. At the end of the month, close the envelope, summarize it on the outside. Gasoline, insurance, cell phone, these are my expenses. Okay? At the end of the year, you bring the 12 envelopes with all the summaries to the accountant. They're gonna love you. They're gonna love you.
It's all organized.
And I'll explain something to you. I charge $250 an hour. If I have to go through the receipts for you, you're gonna get hit with a bill for $250 an hour. If you bring it to me organized, it'll take me an hour to do your return. So it's a big difference. Okay.
This is
can
why it
even-
takes me 3 months to get ready.
But they can even go the extra mile and add up everything for you, and so you don't have to go ahead and add everything.
And if you put it in a spreadsheet, it's even better. I mean, I'm not telling you keep the spreadsheet during the year. You can do the spreadsheet at the end of the year. Okay, but you have all the information in envelopes. It's organized.
Right.
I have clients that bring me literally a paper bag full of receipts and put it on top of my desk. Here's all my receipts for the year. And I said, okay, there's a table over there. Over there, it's free. Over here, it's $250 an hour. I literally tell them that. They sit at the table.
Yeah.
So I can go through the receipts. I have no problem.
Yeah, but it's your time.
For free? No. So yeah, it's important that they keep, their records basically, and also that they understand the laws in their state. Okay, particularly if you're in a state that has the renter's credit, that has the property tax pass-throughs. Just know and keep your records. How much did you pay? How much was included?
Okay, makes
Okay.
sense. So we touched up on this already, but let's touch on it again. Let's say I am a renter and I have a little side hustle going on in my apartment. So utilities, if any, what can I do to help with my
No, the first
Deductions.
the first thing you can't do is take the full utility bill and say it's a full deduction, because you're only using part of the house or part of your rental for the business. So you can only use a part of it. Okay, keep good records. Keep a list of what you paid during the year. I paid $1,900. I have 1/10 of it, $190. So 1 month basically is going to be deductible.
okay, again, limited, but it helps.
Yeah,
Okay.
No, I mean, whatever. If you can take a penny, take a penny.
yeah.
Absolutely.
So, tax prep standpoint, right? How can renters position themselves better to prepare to buy a home?
Okay, the most important thing renters need to do is just be realistic. Okay, first of all, consult a financial advisor and look at your credit scores. Have them look at your full picture. This is what I made in my last 2 years. Take them your last two last two tax returns. Okay, take them your bank statement, your last bank statement, especially if you've been saving for a down payment. Take them all of the information you've already gathered. Look at your credit scores. I have my clients monitor their credit scores for an entire year before they buy. Okay? It's important. Okay, keep looking at your credit score, because somebody could steal your identity and lower your credit score right before you're ready to buy.
Are you recommending a certain place for them to look at their credit score? Because I know from experience, like Credit Karma, it gives you a credit score, your
not
bank,
accurate.
your credit card. They're not very accurate.
No, I usually have my clients pull their annual, like they can join Equifax. Equifax Credit gives you the option of pulling all 3 credit reports anytime you want, and you pay a subscription. I think it's $20 a year. Okay, and you have access to it.
Okay.
Okay, it's worth it because it's accurate. You're also going to be able to dispute. You can lock your credit. If you see something going on in your credit that isn't right, you can text or email the Equifax team, and they lock your credit on the spot. You don't have to pay for a, I hate to do it, but LifeLock or any of those other services. You can do this yourself.
Okay.
Okay.
Yeah, I have my doubts about those.
Oh.
We'll talk about that personally.
So other things that you can do is reduce your debt. So if you have high credit cards or anything like that, people usually tend to live above their means. Okay, and you got to remember that when a lender goes to see you, goes to look at you for a loan, the first thing they're going to look at is how do you manage your finances right now?
Yep.
How are you going to manage another $3,000 or $4,000 payment? Okay, because with taxes, insurance, and everything, your payment could be as high as $4,000. How are you going to manage this? This is your income is limited, but you have $2,000 in credit cards that you're paying right now. That's great. You're paying them, keeps your credit high, but by the same token, it limits how much you have available to pay the rest of the stuff.
Right.
So, there's certain things that you can do. Look at all your options. Okay, if you don't have a down payment for 20% of your tax bill, understand that you may be eligible for programs that will help you with the mortgage insurance. Okay, but the mortgage insurance is also added to your mortgage. So you got to look at all those things.
Yeah.
That's why we sit together and we go through that with a lender, with a bunch of people from our team, so that you are ready when the time comes.
Absolutely. Okay, Olga. So, in summary, any tax deductions that you think renters would be missing out on that maybe you can just briefly point out?
Really, to be honest with you, there are some tax advantage tools that the renters can use. Like, for example, they can contribute to a Roth IRA or to an IRA or to an HSA. HSA is a health savings plan. Okay, that's all tax deductible. Okay, so it lowers your taxable income. You can actually get some money there. For anybody that contributes to a IRA, a regular IRA, traditional, or a 401k through their office, through their work, okay, gets what's called a saver's credit. It's 10% of whatever they save, and it's limited, but they do have a credit that reduces their tax bill. Okay. They can, do different things. There's flexible spending accounts that are offered for like health insurance. That's usually offered through employers, though. So yeah, there's things that they can do to lower their taxable income.
All right, good to know.
Okay. Well, thank you. You kind of answered what I was going to ask you next. Well, that's fine. I have another question for you.
Okay.
Since you brought up IRAs and investment accounts, right? This can apply to obviously renters or even homeowners. Is there any of those accounts that you might be aware of that can actually be used towards buying real estate, especially if you're renting and you want to put money towards something?
So generally speaking, if you have a 401k through work, most of the 401k plans have what's called a loan rider. Okay, that you can take a loan against your money without having to take a distribution. The distributions, remember, are taxable to you.
Yes.
When you put money away in a 401k, you're putting it away pre-tax. You're not paying tax on it. So when you take it out, you got to pay the tax. If you take out a loan, however, there's no tax because your money's still there. You didn't get it distributed, but it's available to you.
Right, you just got to pay it back.
And you're going to pay it back on your payroll. So part of your payroll goes towards paying back that loan.
Do you know of an IRA maybe that's specifically real estate related?
Some banks, will offer you a loan on your balance on your IRA. Again, it's a term loan. It's going to increase your debt to income. Remember that.
Right.
Where the IRA, the 401k loan will not raise your debt to income.
Yes.
Okay?
Yeah.
Because your balances are still there.
Okay. All right, so we had a little bit of a glitch there, but we're back. So, Olga, you had already kind of answered what I was going to ask you. But, so, you mentioned IRAs. So, is there anything that renters can use to put money in that they can use to actually buy real estate?
Yeah, so if you have an IRA, there's some programs in the bank where you have your IRA, or in the investment brokerage firm where you have your IRA, where you can actually take a loan against your balance. Okay? The only thing is, when you do a loan against an IRA, it is a term loan, a personal loan, so it's going to increase your debt to equity. Okay? So, or your ratio is going to go down. Okay, where if you have a 401k from work, and usually they have a loan rider, you can borrow against your 401k and it doesn't add to your debt. Okay,
Right.
because the debt is internal within the 401k itself. Okay, so you just have to be cognizant of that if you're going to borrow against it. Number one, make sure that the brokerage house offers it before you open it. And number two, then make sure that how much can you take, because they also have limits. They usually don't allow you to take more than 80% of the balance.
There's certain
So you have to
limitations.
just make sure that you have enough in there before you go into that. And then how is it going to affect my ability to qualify?
Yeah, I think they're called qualifying events.
Right.
Yeah. So now, is there one that you might know of that's maybe an IRA or something else that's specifically for
Allows for it?
Yeah.
No, off the top of my head, I
No,
don't.
okay. I don't know if
But
there is.
you have to remember the qualifying events that you just mentioned are for distributions.
Yes.
That's where you eliminate the 10% penalty if you're below 55. If you take a distribution from your 401k or your IRA before you're 55, you have a 10% penalty automatic, plus whatever taxes due.
Right.
Okay? The qualifying event for purchase of a home, the first $10,000 of your distribution is not taxable, but it's only 10,000.
Just you're capped at 10.
Yeah, it's capped at 10.
Okay. All right.
Good to know.
Yeah. I mean, wherever you can pull money from.
Yep.
If you're saving it and you can pull money from there, then yeah, use
Save
it.
it, yep.
That's why it's there. For you to use
Just
it.
most people don't know.
Correct.
Right. Or yes, because 401ks or employers tend not to give you that much information about it
Right.
because they don't want you to use the money. Yeah. So,
All right.
All right. Well, thank you again.
Thank you so much, Olga.
My pleasure.
Glad you came back.
My pleasure.
Guys,
Anytime.
subscribe. Don't forget. Oh, and I know producers constantly yelling at me about it. We post on Wednesdays, so watch for our videos. Thank
Thanks,
you.
guys.